what in the actual is going on with office space? Relatively recently, here in Los Angeles, the third tallest skyscraper in the city, known as the Aon Center, sold at a 45% discount to what it was purchased for 10 years ago. That's right, 10 years ago, it was bought for $268.5 million and sold back in December for $148 million. So in 10 years, this property lost so much of its value that it was sold for a 45% discount. Meanwhile, the median home price in Los Angeles County appreciated 84%. So it begs the question, why is this happening? And this isn't just one story. This is one of many buildings selling across the country at staggeringly deep discounts. But they're especially in major metropolitan cities like LA, San Francisco, New York City. Yet you see these scary articles and these crazy headlines, but this isn't the full story. There's actually a lot more to each of these sales, so let's get into it. For the last few years, the commercial real estate sector, specifically office space, has been struggling a lot. And this really began with the COVID-19 pandemic. As the country was shutting down in 2020, corporations no longer needed office space as their employees were working from home. But something interesting happened during this period because, well, companies realized two things. They realized, number one, by doing this, we're saving a lot of money on our leases. We don't need to pay as much to rent an office anymore because our employees are all from home. So that's great. We're saving money on our books. And number two, a lot of employees actually preferred this option. People would rather work at home in their pajamas on their couch and do their work rather than, get dressed up and go sit in a cubicle all day. And so a lot of companies started to actually make a permanent shift to either hybrid or remote work. Jack Dorsey, the former CEO of Twitter, what we now call X, actually made a public announcement in 2020 announcing they were going remote forever. And this story was actually a big headline because for decades, for years and years and years, the office space has been thriving. And it was created as a cohesive and cash-flowing vehicle. Companies need a place for their employees to work, and investors want to plant their money into cash-flowing assets, which for many years were office buildings. Now, before we get into some of these sales, let's talk some statistics. Well, according to a Wall Street Journal article published recently, $38 billion in office real estate is facing distress right now. And distress in this context can mean several things. It can mean defaults, foreclosures, basically just owners and the lenders who lent money to them are facing some sort of burden on $38 billion worth of office real estate. Simply put, owners of office buildings just can't afford to keep paying their debts back. And oftentimes this results in short sales in which these buildings are being sold for less than what's owed on the loan. Now, another important thing to keep in mind is that commercial financing is different from residential financing. So when getting a loan for a piece of residential property, it's very common to get a 30-year fixed rate mortgage, 30-year term, amortized over 30 years done. However, with commercial property, it looks different because this is a lending vehicle that's not as regulated as the residential loans. It's going to be a little different. And so you can find a loan typically for a commercial piece of property that's amortized for 20, 25 years, but it's going to be paid off in terms of 2 to 10 years. Meaning that, let's say your terms are 5 years, you have a 20-year amortized loan, but every 5 years you're going to have to refinance and perhaps put some equity into the deal through a balloon payment or something like that. So this creates an issue with people who can't afford to pay back their loans. Or also, it creates an issue in a high interest rate environment, which is what we're in right now. Interest rates are currently around 7%. And so if a lender issued a loan on a commercial piece of property 5 years ago with terms of 5 years, maybe 5 years ago the rate was closer to 3, 4, 5%. But so now the owner of this building, who's already maybe even underwater on this property because of high vacancy rates and low levels of demand, now they have to refinance this loan at a 7% interest rate, which is actually going to bring their payments up even more, making them potentially even bleed even more on this property. And so it's basically a recipe for disaster. And it's just something to keep in mind because, a fixed 30-year rate, like what you find on a residential piece of property, just can't really be found on typical commercial financing. So let's paint the picture of why office space is doing so bad right now. Well, The number one issue right now is obviously lower demand. This was really created by the pandemic, in which remote work became more so a standard. And now a lot of companies who are shifting more in that direction don't feel the need to renew their office space leases. So as a result, owners of office buildings are dealing with significantly higher vacancy rates, and they're also struggling to find tenants to put into the offices. The second reason really is that these buildings are no longer cash flowing assets. Commercial real estate and office buildings especially were designed to be vehicles that would produce income for those that bought them. And now that vacancy rates are so high, it's such a struggle to find tenants to put into these buildings, they've lost a lot of their value because they no longer can produce income and they're no longer stable investments. So as a direct result, the actual value of what these buildings can sell for is coming down. Because why would anyone buy an office building unless they're buying it for appreciation if they think it's in an area that's going to improve over the next number of years? But unless they're buying it for appreciation or maybe for a write-off, why would someone buy it if it's just going to make them bleed every month? And the third reason really is that a lot of these buildings are being sold at foreclosure auctions. We're in an environment right now in which many building owners are bleeding out every month, and so they can't afford to continue to make their payments, and hence are literally defaulting on their loans. And so these properties on which the loans have been defaulted are being sold for basically pennies on the dollar at these foreclosure sales. So let's get into some of these crazy sales. Well, I'm looking right here. So, in San Francisco, a property sold this year for $22 million after being sold in 2019 for $86 million. In San Jose, a building sold for $34.2 million in March after being bought for $141.3 million in 2019. In LA, Union Bank Plaza, it sold in March for $104 million after being bought in 2010 for $208 million, exactly double. In Washington, D.C., a building on Vermont Avenue sold for $16 million, and it was bought in 2006 for $60 and appraised in 2018 for $72. So these are some crazy numbers. Properties being sold at insane discounts, and it's pretty mind-boggling when you think about it. But there are some stories where you see a big headline, you see a crazy headline, 90% discount. But then you read it and you realize that, it's not actually a 90% discount. So the story that comes to mind is the Burnett Plaza in Fort Worth, Texas. This is Fort Worth's tallest skyscraper. It went crazy in the headlines recently after being sold in foreclosure for just over $12 million. And it was bought 3 years ago for more than $130 million. So that's over a 90% discount. And that number is pretty insane. I mean, you think about it, that's a steep discount, basically as steep as it gets. But there's more to the story. The thing is with this property was that it was a secondary lien that was foreclosed on. And the way you'll typically find a lien used is in a mortgage. A lien basically secures a financial obligation that's due. And so in a mortgage, the lender will issue funds, they'll issue out the mortgage. The buyer then has to pay their monthly payments. But the lender, to protect themselves, they'll pledge this property as collateral, and they'll put a claim on the property, so in the case of default, they can then foreclose on that property. And so the lien is basically just put onto this property as a way of securing that debt. But a secondary lien is subordinate to a primary lien, the primary mortgage or financing on this property. And so whoever purchased this property for $12.3 million at the foreclosure auction, because it was a secondary lien that was foreclosed on, they actually have to assume that primary mortgage, whatever primary debt is on this property. And therefore, if this debt's in the tens of millions, which it likely is, that's also going to contribute to whatever this price of sale was. It's not just $12.3 million likely. Let's say there was a $30 million primary lien on the property, primary mortgage, and they sold the property at foreclosure auction for 12.3, but now you have to assume that $30 million mortgage. And so technically you're buying it for $42.3 million, which is still a lot less, but it's a lot greater than 12.3. And so I'm not sure what the exact number is, but it's probably not 12.3 million flat, which is what all these articles are saying. So that's something to keep in mind. So another property in which maybe the headlines are exaggerating just a teensy weensy bit is the David Hughes building in San Francisco. So this sold last month for $6.6 million after selling in 2018 for $62 million 6 years ago. Crazy, crazy numbers. And one of the reasons this building did so bad was, well, WeWork actually once occupied the building. They had 75% of it occupied, and they chose to terminate their lease early in August 2021, which basically left the owners hanging. And when they defaulted, which was earlier this year, they were at a 92% vacancy rate, which is pretty terrible. So the thing is though, this property sold at a foreclosure auction. It sold for $6.6 million, but just like the previous story, there was still a primary debt on it. And in this case, when it was taken on, so the new owners took on the previous debt, by the time it was actually sold, there was $47 million due on this mortgage. And so yes, it sold for $6.5 million at this foreclosure auction, but the new owners actually took it on and assumed $47 million of debt as well. So that's, if you add it up, 47 and 6.5, that's $53.5 million, which compared to the previous sale price of 62, it's still substantially lower, but not even close to 6.6. The truth is that not all of these sales are really as extreme as they seem. Here's the thing though, I'm not taking away from the fact that the office sector is struggling right now. I mean, it's rough out there. And I feel for all these landlords and owners of buildings who just can't get tenants and are struggling. It sucks. And it's bad for the country, it's bad for this industry. But here's the thing. Throughout history, as big changes have come and sectors have struggled, businesses, consumers, producers, they've all adapted. You know, there's always big changes coming, and change is necessary. It's quintessential for growth. But as changes come, we adapt and we maybe tweak our businesses a bit to fit into these new categories and these new standards. And so what I think is going to happen is a shift in the office space. You know, a lot of these buildings are outdated. Their architectural styles, their layouts, their amenities. And so why would a company want to lease an office space that just doesn't suit their needs? That's totally outdated, honestly even archaic, some of these buildings. And so what will happen, I firmly believe, is that owners of buildings or these new investors coming in and buying these buildings at such steep discounts are going to repurpose them in a way, add in newer amenities. I heard of a guy who bought a building here in LA and put in a spa, a gym, a cold plunge, a sauna, just, you know, things that are up and coming, that are trendy, that employees want. Right? Creating an environment in which companies are going to come to you. Tenants are going to come to you and want your building, right? Putting in those amenities that are so great, you can't even resist. So there's going to be shifts like that. And some of these buildings where there's just no hope, well, I think if it's possible, it's going to look like repurposing them into apartment buildings. And a lot of these buildings have layouts in which that isn't even possible and very inefficient. But some, for those that do, it's possible, and it's honestly pretty damn smart. You know, we need housing right now. We need more affordable housing. And so repurposing these basically dead ghost town office buildings into apartments is pretty genius from an investor standpoint, from an economic standpoint, from a homeowner standpoint. The thing is, it's very difficult to do, and a lot of buildings are not suited for that. But basically, the moral of the story is that the office space is really struggling right now. It's not looking good. But you see these crazy articles, and there's more to the story. But thank you guys so much for watching this video. I really had a blast making it. I plan to put out some more content soon, so stay tuned.